Today, we're going to pull back the curtain on the business world and learn how to give a company a complete health check. And we're going to use some really powerful tools that can tell you just about everything you need to know about its true condition. Think about it for a second. A company can have the coolest products, the flashiest ads, but does that really tell you the whole story? Is it actually making money? Can it pay its bills on time? Is it built on a solid foundation, or is it secretly sitting on a mountain of debt? Answering these questions is how you get to the truth. And that, my friends, is where financial ratios come in. These are the go-to diagnostic tools for any analyst, any investor, heck, even for a student who's just curious. Seriously, think of them like a doctor's toolkit. You've got your stethoscope, your blood pressure cuff, your x-ray machine, all designed to see right past the surface and figure out what's really going on. So here's our game plan for today's checkup. We're going to look at a company's short-term health, then we'll measure its core ability to make a profit, understand its financial risk, and gauge how efficient it is. And then, at the end, we'll put all the pieces together to get the full picture. Okay, let's dive right in with our first test, liquidity. All liquidity really means is, how easily can a company get its hands on cash to pay its bills? You can think of it as checking a company's pulse and its blood pressure. It tells us if the business can handle the day-to-day financial stress without, breaking a sweat. So, what these liquidity ratios are asking is a really simple but absolutely critical question. Can this company pay all the bills that are coming due within the next year? This is all about short-term survival. The first tool we grab from our kit is the current ratio. And look, the formula is super straightforward. You take current assets, that's stuff the company owns that it can turn into cash pretty quickly within a year. We're talking cash itself, money that customers owe them, and their inventory. Then you divide that by current liabilities. Those are the debts it has to pay off within that same year. Easy, right? So what does the number actually mean? Well, a higher ratio is almost always a good sign. Say a ratio of 2.0. That means the company has $2 of current assets for every $1 of debt it has to pay soon. That's a nice, healthy cushion. But if you see a ratio below 1.0, that could be a red flag. It might mean they're going to have trouble covering their short-term bills. Now, for a tougher test, we have something called the quick ratio. Think of this one as a financial stress test. The formula is almost the same, but you subtract inventory from the assets before you do the division. Why do that? Well, because inventory can sometimes be really hard to sell quickly, especially if the economy is not doing so hot. So this ratio tells us if a company can pay its immediate bills without even relying on selling its inventory. It's a much more conservative look. Okay, so we've checked the company's short-term vitals. Now let's see how strong this business really is. We're talking about its muscle and metabolism. This next batch of ratios gets right to the heart of it. How good is this company at its main job? Which is, of course, generating a profit. And a real star player here is return on equity, or ROE. This one's a powerhouse. It measures how much profit a company squeezes out for every single dollar that shareholders have invested. You calculate it by taking the net income, that's the bottom line profit after every single expense and taxes paid, and you divide it by the total shareholder equity, which is basically the net worth of the company. And what this number shows you brilliantly is how effective the company's management is. A high ROE means the folks in charge are doing a fantastic job of using investors' money to create even more value. Generally, anything in the 15 to 20% range is considered pretty darn good. So once a company actually makes a profit, what happens to all that money? Well, as you can see here, it really has two choices. It can pay it out to the investors as dividends, or it can reinvest it right back into the business to fuel future growth. And there's a ratio for that too. The retention ratio tells us exactly what percentage of the profit is being kept, giving us a really good clue about the company's long-term growth strategy. All right, so our patient seems to have a steady pulse and a good metabolism, but now we got to check for any underlying risk factors. This part is kind of like checking for high cholesterol and stress levels. We're about to find out how much this company relies on borrowing money. And that is exactly what leverage ratios do. They measure how much a company uses borrowed cash to run its business. Now, a little bit of debt can actually be a good thing, but too much, that can be a huge financial risk, especially if things in the economy get a little shaky. The classic ratio for this is the debt to equity ratio. It's a straight up comparison of what the company owes versus what the owners have actually invested. You just take the company's total debt, and that's all of it, short term and long term, and divide it by the total shareholder equity. And when you see it laid out visually like this, it just clicks. If that debt bar is towering over the equity bar, that tells you everything you need to know. It means the company is being financed more by lenders than by its own owners, and that signals higher risk for everyone involved. For our final test in this checkup, let's measure the company's reflexes and agility. This is all about efficiency. How well is it using all the stuff it owns, its factories, its equipment, its buildings, to actually go out and generate sales? That's where the asset turnover ratio comes into play. It tells us how much revenue a company is generating for every dollar of assets it has. The math is, you take the net sales and divide it by the company's average total assets. And just a little tip, we use the average of the assets from the beginning and end of the year to get a more balanced picture. So what this boils down to is pure operational efficiency. A higher asset turnover ratio means the company is getting more bang for its buck from everything it owns. It's a sign of a well-oiled machine. But, and this is important, what's considered high can be wildly different from one industry to the next. A grocery store is going to have a way higher ratio than, say, a giant airplane manufacturer. Okay, deep breath. We've run all the individual tests, we've checked the pulse, we've measured the metabolism, we've assessed the risks, and we've tested the reflexes. Now it's time to bring every single one of these results together and make our final diagnosis. So why does all this matter? Well, because these ratios let us do some really powerful things. We can track a company's health over several years to see if it's getting better or worse. We can use them to make a pretty educated guess about how it might perform in the future. And maybe, most importantly, we can compare it to other companies in the same industry to see how it stacks up against the competition. And if you remember one thing from today, let it be this. A single number by itself doesn't tell you the whole story. It can even be misleading. A skilled analyst, just like a good doctor, looks at all the test results together, sees how they connect, and only then makes a final diagnosis. Because in the end, that's what these numbers really are. They aren't just figures on a spreadsheet. They are the building blocks of a story. A story about success, about struggle, about risk, or about a huge opportunity. And now you have the tools to start reading those stories for yourself.